All right, let's get into it. Today we're looking at PLTR, Palantir Technologies. Now this is a company that creates some of the strongest opinions you'll find anywhere in the market, and we're about to see exactly why.
Welcome to Cyberstock Reports. Today, we're decoding the mystery behind Palantir Technologies. As you can see, our analysis is based on data as of December 11th, 2025. And just a quick reminder for everyone, this is an AI-powered simulation. It is not financial advice. Please, invest at your own risk.
So the big conflict with Palantir right now, it's this fascinating paradox. You've got a company that is executing at a Hall of Fame level, truly Class A performance. But that performance is clashing head-on with a valuation that, well, a lot of people think is dangerously high.
And this is the number that's causing all the anxiety. A price-to-sales ratio of 113. Now you got to understand, for a company of Palantir's size, a multiple this high isn't just pricing in a little bit of future growth. No, it's pricing in years and years of flawless, world-dominating execution. This is the absolute core of the risk. But then, you see this.
A Rule of 40 score of 114%. Now, for those of you who might not know, the Rule of 40 is a quick check for a healthy software company. Its growth rate plus its profit margin should be over 40%. Palantir is nearly triple that. This number puts them in this elite, almost unheard-of class of performance. And there it is, the paradox in a nutshell. A terrifying valuation meets absolutely world-class execution.
So let's start with the bull case. It really hinges on this powerful idea, this narrative shift, the idea that Palantir is no longer just another software vendor. No, they're becoming the critical operating system for the physical world. We're talking industry, defense, energy, you name it.
And the evidence for this story? It's pretty compelling, you know? Their U.S. commercial business is just on fire, growing at 121% year over year. So this isn't just about government contracts anymore. Then you have what we're calling the ShipOS mode, a massive $448 million contract with the U.S. Navy. That's huge validation for their strategy of embedding tech right into physical hardware. You throw in key partnerships with giants like Nvidia, and you can really see the powerful story they're telling the market.
Okay, but now we have to look at the other side of the coin. The bear case. The professional question the bears are asking is simple, and it's disciplined. What price is just too high, even for this incredible level of growth? Are we maybe seeing a bit of history repeat itself?
And this slide right here, it frames the entire debate perfectly. Are we looking at a rocket ship, kind of like Nvidia was in 2023, where a sky-high price was totally justified because the company was literally about to redefine an entire industry? Or is this a tombstone, like Cisco back in 2000? A fantastic company, no doubt, but one whose stock became dead money for a decade if you bought in at the peak.
This chart puts that risk into really stark visual terms. This is what we call valuation vertigo. PLTR is trading at roughly a 600% premium to its own high-growth peers like Snowflake and Datadog. So the key takeaway here is the market isn't just pricing imperfection, it's pricing Palantir as if it's in a category of one.
Now, if this was just a simple battle between fundamentals and valuation, that would be complex enough. But there's a wild card in play here. There's a technical factor that kind of defies fundamentals and really helps answer that why now question behind the recent price surge.
And that wild card is the short squeeze. So what is that? Well, it's what happens when a stock's price shoots up really fast, and it forces all the people who bet against it, the short sellers, to panic and buy shares just to cut their losses. All that buying adds fuel to the fire, creating what we call invisible buying pressure.
And for Palantir, let me tell you, this is not just a theory. It has an S3 squeeze score of 82.5, which is really high. This score measures how likely a short squeeze is, and a number like this suggests that the stock's recent sharp V-shaped recovery has trapped a ton of short sellers. Their forced buying could be helping to push the stock higher, completely separate from that 113 times sales multiple.
So, where does all this leave us? We have to bring these two warring narratives together. And the verdict is that we're looking at a genuinely great Class A company, but one that currently carries the risks of a very, very dangerous stock. The truth is, both sides have extremely valid points.
So how do you make sense of this for yourself? Well, let's break it down by investor profile. If you're a momentum trader, that technical breakout above the key $1790 level combined with that high squeeze score, those are powerful green lights. The trend is your friend, and it's being supported by that invisible buying pressure. But if you're a value investor, that 1,113 times sales multiple is an absolute non-starter. The air is just too thin up here, and you're probably going to wait for a major correction before even thinking about it. And that leaves us with the ultimate question, doesn't it? Is Palantir on a path to become a trillion-dollar sovereign asset, a truly indispensable part of our industrial and defense infrastructure? Or is it a trap, destined to become a decade of dead money for anyone buying in at today's euphoric prices?
Finally, please remember this is an AI simulation. The final investment decision is yours and yours alone.